We start today's market talk. You are constantly bombarded with headlines and expert analysis about Trump's potential impact on the markets. It's overwhelming. Economy and politics are complex machines with countless moving parts. Too little attention is paid to second order and even higher order effects. Instead, we need to focus on simple, timeless principles for successful investing, which are buying quality businesses at fair prices and letting compounding work its magic. Market outlook, as I see it, US stock markets have reacted euphorically with both S&P 500 and the Nasdaq at record highs. The market clearly expects that Trump's agenda of tax cuts and deregulation and his general pro-business stance will boost growth. There is a big gulf between election rhetoric and hard realities otherwise in policy making. In addition, the Fed has cut the interest rates by 25 basis points, and Powell said that US economy is in good shape and inflation is easing. In addition, IMF has flagged protectionism and geopolitics as the downside risks to economies. Now, keeping all these things in mind, US long-term bond yields have gone up because investors are demanding an additional yield for taking on the risk of long-duration securities. Term premiums are higher because the future is murkier. Also, Trump's actions could bring a paradigm shift in the existing global order in terms of US support to Ukraine, European defense and trade with the Europe, Middle East with China, which is focused on Taiwan and India Pacific region. There is a possibility of a conflict on technology and standards of future between the two countries. In addition, Trump has a difficulty working with WTO, IMF, UN, World Bank, etc. US positioning on crude will be extremely crucial in deciding the direction of its prices. Expectations are that US stance will favor lower oil prices, which will lower inflation. Persistent selling by FIs. Within our country, FI's ownership of Indian equity has hit 12-year low and has dipped below 16%. Reason could be geopolitics, Chinese stimulus, US elections, valuations in absolute and relative terms, and earning downgrades. China plus one, Make in India theme should gain more prominence during the new US trade regime if US adopts tougher stance on China in terms of tariffs. India, along with Mexico and Vietnam, could emerge as favorable manufacturing hubs. Electronics and smartphone manufacturing could be the key beneficiary sectors. Now, coming to US markets, Dow Jones took out 44,000 level. The Trump trade gripped markets with S&P 500 and Dow notching their best post-election intraday climbs. Expectations are that Trump's policies favor lower taxes, less regulation will help corporate earnings, and it will be reflected in gains for the US markets. Now, due to uncertainty and depreciation of other currencies, US dollar has risen, which is having a negative impact on gold prices. So now let's see the US bond yields. They were correcting, had come down to around 3.5 or 3.6 levels. And then once the probability of Trump's victory rose, they have climbed back up and nearly touched 4.5 before the 25 basis point rate cut. But the trajectory is upward and it is likely to remain high as I have already discussed. Dollar index has also broken through the declining trend line and is headed higher. Now, if you see here, it had declined from around that 115 level to 100 level. So that is 15 points. So the retracement has been around 5 points. That is roughly around 30%. it can easily replace 50%, that is to around 107, 108 level, or 61%. So that would be around 110 plus or 111 levels. So those levels are likely over a period of time. Brent crude is declining and is now at around 70, below 75 levels and below the 20 and 50-day moving averages. Gold is being on a was on an upward trajectory. Now it is correcting. It went up to 2800, and in last 2 weeks it has come down below 2700 to around 2650 levels. So future path of the dollar has to be seen to see what happens with gold. But uh, when there is a when there is a risk on trade, the money, incremental money moves from safer assets like gold and bonds to things like cryptos and uh, tech sector, which is as it is doing well. Copper has declined and has come down below the 20-day moving average. This is because the stimulus from China was slightly underwhelming. Nasdaq was up 5%, 5.4% last week, based on momentum in the US equities and especially Tesla, and it is trading above the 20 EMA on the weekly charts. Dow Jones made a fresh high, touched 44,000 and was up 4.61% last week. It's on an upward trajectory, and now this upward trajectory may become steeper with the momentum in the US markets. Now, coming to Indian markets, India VIX declined. It had gone up to around 20 odd level during this US election day. But subsequently, after there is a confirmation of the results, it has corrected and is likely to go down further as the event risk starts getting over. Coming to Nifty on the weekly chart. So if you see here, it is below 20 EMA on the weekly chart. So that is a weaker sign. And it bounced from the second swing low it had made. So this should be, this 23,850 should be a clear support zone. Once this break, then there is a possible movement down to this 23,500 level. On the daily charts, it is now creating another head and shoulder pattern, whose logical target should be around 21,500 or the somewhere close to the election day low. Once these levels break, but the immediate target once these 23,900, 23,850 level breaks, the last low over the last week, then it will head to the 200 EMA at 23,500. On the hourly chart, so if you see here, it's on a constant downward trajectory in whole of October and is constantly making lower lows and lower highs. It tried to break above this trend line, but then it has rapidly corrected and has come down. It is even on hourly chart, it is below all the moving averages and is looking weak. So market is likely to remain in a corrective phase within a range of this 23,850 to 24,500. There isn't sufficient upside momentum to carry prices higher on a breakout, while breakdowns are also getting bought in. So may not also see new momentum on the downside also. So right now it is consolidating. So best strategy is to trade long at support and short near resistances. In the aftermath of US elections, there is a greater risk on sentiment in the US. Money may move out of gold into cryptos and technology sector in the US. Bearish control on Indian markets may continue. Many were willing to call for an end of bad times with Trump's victory, but technical indicators are not in support of such a view. Market can slip into a consolidation mode for a while and keep everyone guessing about its intent. If you recognize that, you will not get whipsawed by the swinging market. Now, Nifty Bank, you see, it is relatively stronger. It had gone up, but last week, but then has corrected. It has come down below the 52,000 level, but it is still above the 20 EMA. On to the daily charts, it is consolidating around this 100 EMA. And now the 20 and 50 EMA on daily charts have come very close, but it has broken below those 50 EMA. So it may test this 51,200 level, the 100 EMA, maybe next week. And if this breaks, then it may test the somewhere around 50,000 level, where the 200 EMA is poised. Now, HDFC Bank is strong and is keeping the Nifty Bank and Nifty higher. It it corrects from this 1800, 1780 to 1800 supply zone, but has support at the lower level. This week, the MSCI incremental money which is coming into this is keeping it higher. So watch out for these levels, and it uh, but it is not looking to go up also. Reliance, it's in a downward trajectory and is looking very weak. On weekly charts also, it has come below the 100 EMA and may test the 200 EMA of 1225. If this breaks, it has retraced 61% already of this complete up move it took, which took it up from 1100 levels to 1600 levels. And now it has come down that. And if it doesn't bounces from here, it may retrace completely this whole trajectory. Though in between this 12, 20, 25 level of the 200 EMA on the weekly charts may provide some kind of a support. Midcap index was weak last week, and then after a bit of a bounce, it also corrected, but it is slightly better than Nifty. It is still below the 20 EMA on the weekly chart, but it is in this zone now. So till time it doesn't break these levels, it is okay. Small cap index also, it had bounced above the 20 EMA, but then it corrected, couldn't sustain the high levels. It was sold into. So these lows which were made in October need to be held for otherwise, if it breaks the highs of the the election day high, then it will become weak. I'll cover three stocks. The first one is CG Power. It's a prominent player in the electrical engineering sector. It operates in two business segments, industrial segment and power systems. Industrial segment system accounts for 67% of the total revenue, and power system accounts for 32%. Industrial systems stand to benefit from shift towards energy efficient motors, where the company holds 35% market share in low tension motors and increased adoption of advanced drives. Power systems, potential beneficiary of heightened demand for power equipment driven by renewable energy integration and enhanced power evacuation from thermal plants. Railways, it stands to gain from platform modernization. Platform here means the trains part, engines and trains. It can address 25 to 30% of the orders, particularly in high-speed trains, where the company can offer propulsion systems, including traction motors, traction transformers, auxiliary transformers, and traction electronics. Growth in outsourced semiconductor assembly and testing OSAT is a key monitorable. It has made a joint venture with Renesas Electronic Corporation and Stars Microelectronics with an outlay of rupees 7,600 crore with focus on the assembly, testing and packaging of semiconductors. Growth via inorganic acquisition, rupees 1,300 crore to be spent of the proposed QIP of rupees 3,500 crore, mainly targeted towards increasing export penetration. It is entering new lines of businesses, motors for electric vehicles and covered systems. It has strategically acquired a 55% stake in GG Tronics Private Limited for rupees 320 crore. GG Tronics specializes in designing, manufacturing, supplying and installing electronic safety embedded signaling system for the railway sector. It holds an 8% market share in power transformers and 6% share in distribution transformers in India. In switchgears, the share stands at approximately 22%. It is the first company to indigenously develop and supply a complete range of high-efficiency motors, including IE2, IE3, IE4, and the recently introduced IE5 ultra premium synchronous reluctance motors in India. Expect a revenue CAGR of 27%, EBITDA CAGR of 31%, and profit after tax CAGR of 32% over FY24 to 27. CapEx of 690 crore, which they are planning to do, will help achieve an incremental revenue of 6,400 crore at peak capacity. Its well-timed capital allocation, perfectly aligned with industry tailwinds, presents multi-year growth prospects. Now, coming to their income statement, it is expected to do around 9,800 crore of revenue in FY25 and around 1 to 9 12,900 crore in FY26 and 16,300 crore in FY27. So there is a decent revenue growth. And net profit after tax is also going to be improving to around 1456 crore in FY26 to around 1937 crore in FY27. It is likely to report EPS of approximately 9.53 in FY26 and 12.68 in FY27. The EBITDA margins are improving and revenue growth is also decent, and EPS is expected to grow around 35% on CAGR. In business segments, it has two basic segments, as I've discussed: industrial systems, motors and drives, and railways; power systems, transformers, switchgears, and other allied products. In power, the segment offerings are transformers, various types of transformers, power distribution, low power, locomotive, etc., and switchgears, MV switchgear, relay and automation, EHV switchgears, etc. Strategic capex in transformers and switchgears to translate into incremental revenue of 2,800 crore. Now, power systems order inflows is expected to record 31% CAGR over the next 3 years, and revenue is also likely to improve substantially to around to these levels. Power system margin to see strength, and margins are likely to improve to around 18% over the next 2 to 3 years. Motor drives and industry size and CG market share. So if you see here, in low tension motors, large industrial motors, fractional horsepower motors, they are increasing their market share. As you can see, in LV motors, they are constantly increasing their market share. This is the cost structure of a Vande Bharat train. CG Park can cater to 25 to 30% of the total. So cost of one Vande Bharat train is around 116 crore, considering around 200 crore of labor cost. So out of the balance, it can provide this 22 crore is there possible where they are involved in each train. Now coming to their charts, it is on a constant upward trajectory. Took support earlier also at 100 EMA. It made a high of around 875. Then it has corrected now and is now consolidated around this 100 EMA. So this 100 EMA around 700 level is a good opportunity to add this stock. Next stock on the list is SAIL. So for understanding stocks which are dealing with steel, one has to get into understand what is happening with China. In China, there is a weakness in property market, and because of that, the steel demand continues to remain low. China steel prices have bottomed, likely to move towards $580 per ton in FY26 from $490 per ton now. So it is likely to improve further, which will impact the prices of steel all over the world. Capacity expansion to help buffer Indian players' profitability, much better placed than previous cycles because they have deleveraged their balance sheets. Value addition and cost efficiencies, captive coal, better logistics will aid further expansion of unit profitability. Amidst weak China prices and rising imports, raising the import duty from 7.5% to 12.5% right now is an option for the Indian government. China's imports have risen 120% year on year and are now 30% of imports in India. India's steel demand has been rising at 10% growth, surpassing GDP growth over the last 4 years. With the absence of higher volumes and elevated leverage, SAIL should trade at a discount to peers. While its peers are adding capacity, SAIL is still slowly ramping up its volumes. Any new capacity addition is years away. Highest degree of operating leverage due to higher fixed cost for SAIL. So what happens is, since their fixed cost is the highest, so any incremental change in volumes or the prices straight away impact the EBITDA positively for them. Now coming to their financial performance. So if you see here, uh, their revenue for Q2 declined by roughly 5,000 crore. This is in crores. This is because I think the EBITDA margins have declined, and EBITDA also declined roughly around 25% from 4,000 crore to 3,100 crores. Rest of the parameters are the same. And profit after tax, if you see year on year, has also declined roughly 25 to 30% from 1,241 crores to 834 crores. And same decline is also observed in first half of the year's performance also. Now coming to operational and financial parameters, though their volumes are likely to go up, and even in this year, average selling price is going down. It has come down by 5,000 rupees per ton, and that is what is impacting their EBITDA, which has come down in a large way. Their cost generally remains same because of higher fixed cost. Hence, moment the average selling price improves, it directly improves their EBITDA per ton and overall EBITDA also. So coming to their yearly revenues, FY25 is expected to be a low year. They were going to drop 5.5% from last year, but next year they are expected to improve revenue by 10% and then 5% after that. EBITDA is going to improve around 67%. And profit after tax is going to be around 4,000 odd crores and go to 4,800 crores in the FY27. So their margins are improving. ROE, ROC are improving. They are expected to do an EPS of around 10 to 12 rupees in FY26, FY27 with EV EBITDA much cheaper, around 6 level as compared to other steel companies. They have high fixed costs as compared to peers. As I have told you, JSW and JSPL are much lower, while Tata's are somewhere around 4,000 rupees per ton. Sale volumes are lagging growth seen by peers. So volumes are not improving much as such because they are not adding any new capacity. Average selling price per ton to improve as global prices recover from cyclical troughs, and EBITDA per ton to recover from FY25 lows. So it is expected to reach around 7,500 rupees per ton as average selling price improves. Now comparing them with peers, JSW Steel will see 36% volume growth next 3 years. Tata's will see 21%. JSPL will see 69% volume growth, and SAIL is likely to only see 5% volume growth. Profitability will improve due to higher spreads. So JSW will have better EBITDA per ton and will reach around 15,000 rupees per ton. That is EBITDA. Tata Steel will also reach higher than that because of more cost efficiency. And same with JSPL. SAIL is going to be half of that in terms of EBITDA per ton because of their higher fixed cost. And seeing their chart, so if you see here, they are making constantly lower highs and lower lows. And from a high, it made around 175 around election day. Before election day, it has come down and has come down to 115 or 110 level. So from these levels, even next year, maximum it can go up to 130, 140 levels, where in short term it will face a lot of resistances, and due to uncertainty of future steel prices, it is likely to remain subdued. Last stock today is Raymond Lifestyle. Revenue declined 5.3% year-on-year to rupees 1,700 crores. Growth was impacted due to slowdown in demand, weaker consumer sentiment, and higher inflationary pressures in the last quarter. Second half FY25, we can expect a good traction for its products. Led by festivities and weddings, there are around 45 to 48 wedding days in second half FY25 versus 11 to 12 wedding days in first half FY25. In branded textile, it entered the ceremonial fabric space. It also launched Bello Italiano, which is focused on Italian fashion and designs. It launched Sleeps by Raymond in second quarter. Garmenting over the past few months, it has successfully added over 20 new clients across key markets, including US, UK, and Europe. It is obtaining some orders due to Bangladesh plus one strategy. Ethnics by Raymond, it expects a wedding wear market to grow at 12 to 13% CAGR as weddings have changed from 2-day event to 5-6 day event nowadays. Company targets to open 200 stores over the coming 18 months, primarily following an asset-light franchise model so as to reduce their cost. Now coming to their quarterly revenues, from 1,800 crore last year, it has come down to around 1,700 crore. So there is a dip of 5.3% year-on-year, but improved Q on Q. EBITDA margins are also came down. Adjusted PAT has come down from last year, but improved Q on Q. And adjusted EPS is around 16. So they are expected to do better in the next few quarters. Now coming to their profit and loss, they are expected to do around 7,500 crores in FY26 and 8,400 crore in FY27, with operating margins improving to around 14-15%. And they will have a EPS of around 112 to 133 in FY26, 100 FY27. Considering that their average EPS of around 120 over these 2 years, they can easily trade at 25 times. So which should be between 2,500 to around 3,000, they can easily trade. They are going to show a revenue growth around 10 to 11%. And PE is relatively good, while ROC, ROE, etc. are all improving now. Operating margins are also improving. There are four segments. Branded textile revenue dropped by 8.5%. Margins are also relatively better from the last quarter. Apparel revenue, branded apparel was also flat and margins have improved, but they are around 13%. Garmenting revenue dropped by 9.3%, but EBITDA is around 9.6%. High value cotton shirts revenue grew by 8.3% year on year, and EBITDA margins are come to 9.7%, but it is expected to improve now. This quarter is expected to be soft. So one of the brokers have valued them at around 2,789, considering for FY26, considering the valuation as per FY26 earnings for all four segments right now. So this stock was relisted in September. It made a high of around 3,000 plus, and then it corrected after a few lower circuits. After it has been consolidated, went down to around 2,000 and then has bounced back. But every dip to 2,000 is a good buying opportunity in this stock. So I have finished. We will take questions now.